If you consider yourself a maximalist or a hodler, then you probably shouldn't be trading. That type of mentality will never help you in trading.
Hello and welcome back to AIBC Summit YouTube channel. Now in this week's video, I'll be joined by Kevin Murcko, CEO of CoinMetro Exchange, and we'll be taking a look at some of the biggest headlines that we've seen this week. So if you are a fan of the space or you're looking to learn that little bit more, be sure to give this video a big thumbs up, hit that subscribe button and keep watching. So Kevin, starting off, I do want to touch on something that we saw this week. As we know, cryptocurrency trading does run 24/7. So when we see the stock markets halt, like we saw earlier on this week, does this really highlight the need for decentralized assets and cryptocurrencies in the space?
Well, that depends on what kind of investor you are, I guess. I think that, look, the traditional markets aren't perfect. I think they prove that time out. But in terms of being a perfectionist in markets, cryptocurrency markets or crypto asset markets aren't perfect either. So, depending on what your risk tolerance is, those circuit breakers that you mentioned in traditional markets can be a lifesaver. You can look to see how they affect the market and make a decision whether you think they actually have, that their intended effect is actually what is happening, or if something else is happening. But the truth is that when those 7% are hit, or 13%, and then I think 20% is they cut off for the day. When those circuit breakers are hit, they do give traders time to sit back, the panic to kind of wave away, them to maybe look at some news reports, figure out what they're going to do, and then attack the markets in a different way. And I think without those circuit breakers, you probably would have saw more carnage on certain days. The funny thing about circuit breakers is they only put them on the downside, which you could also argue, if you're someone shorting the market and the market goes up by 20% in one day, where's your circuit breaker? So I don't think it's a perfect solution, but I don't necessarily think it means that decentralized markets would be better. I think what it does maybe signal is that there would be more of a quote unquote free market. But I've seen many instances of very free markets kind of backfire on investors as well. So, as crypto markets start to begin, or they've already began to mature, but as they mature more and more, as we see more and more regulation, we probably will see more traditional methodologies applied to crypto asset markets, like we see in traditional equities or bond markets. And that may or may not be a good thing. But the problem is there's no alternative. Nothing has been tested to this point. And I think, the way the volatility in crypto markets as it is now, because they're illiquid, would probably force the regulator's hand to actually apply these same type of methodologies. Again, I'm not saying it's good or bad, but it's probably what we would see, because at the end of the day, the regulator's job, or what they say their job is to protect the retail investor. That's one of their main focuses, right? And in their eyes, this protects the retail investor. And I think they can make a pretty good argument that it does. I could make a good argument it doesn't, but I think they're going to make a good argument that it does. So we'll have to see what happens over the course of the next 2 or 3 years as more and more regulations apply to the market.
And you're right that for a retail trader, those 15 minutes can be really crucial for working out what's going on in the market and also assessing the risk. On a counter argument, would we argue that actually for retail investors that are from the traditional financial space, maybe they would be more likely to enter the crypto markets if they had the same level of security?
Yeah, I think it even goes beyond security. It's just what you're used to. So, if you're a futures trader, you may really like Bitcoin, but you have no idea what a private key is. You don't know what a public key is. You're scared to hold assets by yourself, to hold them on an exchange, because all you see are contrary news reports. And even when you're a professional in let's say finance, who understands traditional finance, it can be difficult for them to apply that same understanding to a new asset class or a new market like crypto assets, for example. So, they may look at these things. It's just too much of a learning curve. So when you apply if they're able to access those markets from something that they understand, I don't even think the security kind of concerns or volatility, none of that is really the problem from a professional trader standpoint. It's more about the fact that they want to be able to press a button and move on. They don't want to have to do a bunch of other things that they don't have to do with their traditional assets. So in that way, yes, futures and other types of more exotic instruments, whether they be default swaps or convertible, any type of more complex instrument that we will see over time, would probably be easier for any traditional financial player to get their head around, rather than having to deal with what is more a deliverable of an asset they don't quite understand, which when you don't understand something, usually it leads to you being more scared, more anxious, more etc. Even though, like I said, you would assume they would understand because they come from a financial background. But that's usually not the case, unfortunately.
And you're right that even in the cryptocurrency market, which is known to be volatile, we have seen 17% drop on Bitcoin in just 48 hours. When we look at the options of cryptocurrency derivatives, Bitcoin futures, are they a more appealing option for cryptocurrency traders when there is such volatility in the space?
Again, it depends. There's a problem that exists when you have an immature underlying market that decides to move into very mature, complex, products. So normally, what will happen in a market is you have a very matured underlying market, and then, and only then, do you start to create synthetics and derivatives and other type, mainly to expand your liquidity base, or perhaps to make it easier for professionals to get involved, or perhaps to enter into different markets. Here, we kind of went backward. We didn't go backwards. We had an underlying market, but we had a very illiquid, we still have an illiquid, but we had a very illiquid underlying market. And someone had the idea to create these more, let's say, complex synthetic offers. So the problem exists in that the prices are still going to correlate. So you can make the argument that the synthetic, let's say, no ceiling, no limitation on liquidity product, it should have less volatility, but it's still going to get price markers from the underlying market. And the problem with the underlying market is it's 100% OTC, no centralized pricing. Obviously, if you have a very liquid exchange, pricing can be very different than a very illiquid exchange. Or even if you have two liquid exchanges, let's say one in Argentina and one in Zimbabwe, and then you're checking price against one in Switzerland, obviously you're going to have three very different prices. So the question then is, if you're operating on a global synthetic market, what should the price be? And if you're creating these arbitrage opportunities, are you actually helping or destroying the market? Are you adding more confidence into people, adding more confidence in the market, or are you taking it away? So I think it depends on what kind of trader you are. I think for most traders, they're probably looking at both sides of the candle, so to speak. You don't want to be involved in a fully synthetic, or even something that's not fully synthetic, but that isn't based on, let's say, a deliverable, versus something that you kind of have to be on both sides, which means you're not only looking to make money maybe from speculating, it's going to go higher or lower. You're also trying to make money regardless, meaning you're arbitraging yourself and you're hedging yourself between the deliverable and the synthetic. So I don't think one can, I know that one can't exist without the other. You can't have a synthetic without an underlying product. And eventually with an underlying product, you need to have synthetics. So I think a smart trader will use both. And I think that the liquidity problem or the volatility problem doesn't really go away until there's substantially more market infrastructure on the deliverable side. That's the issue. And that issue won't be solved by Bakkt or by any other institutional, let's say, futures provider, because they have nothing to do with the underlying core infrastructure of what is crypto trading.
And you're right, Kevin, this is such an uncertain time. So as someone that did used to work in the financial markets, how would you assess the current market status, and how should a cryptocurrency trader, how should they move forward, and what kind of positions would you expect for them to hold?
I think this is one of those days or weeks where you can almost say that even if you're a traditional investor today, you probably need to listen to the same advice. We've seen the Dow, we've seen the FTSE, the CAC, the Nikkei. They've all been super volatile. Single stocks, single companies are down, 40, 50% since the beginning of the year, mainly because of this economical war we're fighting right now globally, which we like to call coronavirus. So I think that what you should always do the same thing. Never get married to a position. If you consider yourself a maximalist or a hodler, then you probably shouldn't be trading. That type of mentality will never help you in trading, right? It can help you, I guess, through tough times as you hold on to your assets. But you definitely shouldn't be having that same mentality when you're trading. But you can be both, right? You can be a crypto hodler and hold on to your Bitcoin, but you can still day trade so that you can, or it doesn't necessarily have to be day trading, but you can still trade so that as your portfolio loses value, you can try to balance it out a bit with daily, weekly, monthly gains. So I think you don't get married to a position. You need a risk strategy. Trading is all about risk. All right. I used to teach trading. I used to teach FX trading. I used to do this famous thing where I had two dartboards. One had pairs on it or assets. The other one said buy or sell. And I would blindfold people, and it took a long time for them to hit the board. Sometimes we were there for half an hour. It was quite ridiculous. But eventually they would hit, let's say, sell euro. And then they look at the charts and euro was up by, I don't know, 3% over the last 4 weeks. And they said, well, this is a terrible trade. Maybe not. And if you have a risk strategy, and regardless of the trade you take, you follow your risk strategy, and your risk strategy is at least 2 to 1 to 3 to 1, meaning you're not risking, you're attempting to win at least, let's say 2 to 3 times more money, or at least 1.5, than you're attempting to lose, and you follow that strategy, you will be a winner at the end of the day. The problem with most traders, the problem with all traders that lose money, is psychology. So you need a risk strategy, and you need to be able to sit on your hands. If you can do that, it doesn't matter how volatile the market is. It doesn't matter if it goes down 50% a day, 90%, 130%, makes no difference. I don't know how you can go down 130%, but you get the drift. The point is that you follow the risk strategy, you will end up making money. But it's the hardest thing to do. Human nature always fights against this. So, find a risk strategy that works for you and always follow it regardless of your positions. And you don't have to be in the market. If you're don't be one of those people that says, if I would have bought last night, I would be up 80%, I'd be up 30% right now in my portfolio. What an idiot. No, you didn't buy last night because you didn't see a reason to, and that's a good trade. Not getting into a trade is just as good as getting into a winner, and getting out of a loser at the right time is just as good as getting out of a winner at the right time. So I think that's the main thing that people need to learn.
And something that we did see when it comes to regulation was the way that the US recognizing cryptocurrency. So a bill's been put forward, which is the Cryptocurrency Act of 2020. So it will look at restructuring and identifying cryptocurrencies in 3 different ways: crypto securities, crypto commodities, and cryptocurrencies. What's your thoughts on this?
Well, I would say the opposite, but not necessarily for the representative from Arizona that put the bill together. Obviously, he didn't write it. He just presented it. Most legislators don't write bills. They're 35 kids that go to college that work in a basement somewhere are the ones writing it. I would say that it shows me it's a very vague interpretation of what crypto assets are. And the reason that you can't classify crypto assets into 3, 4, 5, 7, 12, or even 50 categories. It's the first time we have, because you're basically, in the past, you would take an asset simply based on the, let's say a checklist of what that asset is, and that's how you would classify it. But now you have basically we're building assets on a delivery system, right? Meaning DLT or blockchain is the delivery system. And you can build anything onto that, right? You can create types of assets that don't exist yet. You can create assets that don't fall into any current category. So trying to squash them into 3 categories, I would make the argument we don't yet have a cryptocurrency. If you take let's say a more traditional definition of what a currency is, crypto commodity, are you classifying what? Bitcoin as a commodity? How is that a commodity compared to other commodities? How do you actually define that? And how many crypto commodities do we actually have? And when you talk about crypto securities, okay, bonds, equities, et cetera, got it. But what happens when you create a derivative? What if you have an asset that you use to fundraise, but you use to fundraise on a platform that provides utility? But then after that, it becomes an equity. And then in the midst of that, maybe it's a convertible bond. So what do you classify that as? All 3? Just 1? None of them? I think the point is that the most legislations, this isn't legislation yet, right? This is a bill that's been drafted. It hasn't been officially voted on. It's not part of the law, and I don't think it will be. I think it's great that they're trying, but this is very far from what needs to be done in order to really encompass. We have all the laws we need. What we really need is a baseline document that basically structures where the exemptions are and then applies current regulation to everything else. And there's going to be way more exemptions than there are current applications, right? But I think globally, what you're starting to see through 2019, 2020 is an awareness that it needs to happen. They still don't understand it. They still are vastly, I think, missing the point on what crypto assets are and how this will kind of change the way that the financial markets work and function in many ways. But they're actually starting to make suggestions. And that's a good thing, because then people like us get to comment on it, and then new suggestions come out and new suggestions. And then finally, we get something that hopefully is something that'll help both the legislative side, the regulator, and the investor and trader as well.
And this is the first time that we've spoken in 2020, Kevin. So I do want to touch on what we've seen. So in March alone, we've seen news from the US, we've also seen from South Korea and India as well when it comes to regulation and also representatives. How are you seeing 2020 so far, and are we making headwinds?
I think 2019 probably a lot of that happened. Obviously we're very early into 2020. I don't think that all these talks and all these kind of decisions were made in 2020. I think they were probably made in 2019. I think, the regulation process, which everybody talks about regulators, right? But the regulator is only there to basically make sure the legislation is followed, right? It's the legislators that really need to do the job. And when you talk about countries like the US, it's judges that need to do the job, because most laws are created by judicial precedent, right? Legislators don't want to do anything until a judge says something is right or wrong. Then based on that, they create the law. And then based on that, the regulator tries to enforce that law. So it's not really the regulator. The first step is not regulation in most parts of the world. I think that, I've heard a lot of talk, and I actually, back one of our very old interviews that we did in the past, Jessica, we talked about the RBI when they put the ban in the first place. And I said, and before the ban happened, I said they would ban it, then they would think about it, and then they would unban it. And that's not because I'm a genius or I have a magic 8-ball that actually works. It's simply because that's what happens all the time. That's what happens that's what happens literally with pharmaceuticals, with any type of regulation that applies to like some type of end business. That's always what happens. And I think South Korea didn't really pass anything, actually, because you have to understand that legislators act usually in first place to help other pieces of government, right? So what South Korea did was simply to legalize it officially, so that they can eventually tax it. They can structure the ways that they can police it, et cetera. They can't do any of that unless it's actually legal somewhere on the books. It's been quote unquote legal in South Korea forever. There's exchanges there. They've attacked a few exchanges, mainly because they just had bad practices. But this is just a way of them of kind of cementing their feet to the ground so they can actually do their jobs. Same thing that happened in China when they said that crypto was property. That means they can seize it. It's the only reason they said it was property, not because they like it. Just means that if there's criminal proceedings or not, they can seize those assets now because they're considered property. So I think that, sometimes we have to kind of look back and you kind of take a step back to move forward. But definitely 2020, we will see lots more news on the legislative and regulation front. I don't think we're going to see much super clarity in terms of regulatory probably throughout this year. But this year still will be a year of regulation and a year of legislation. That's for sure. And that probably will continue for the next 2 to 3 years until eventually we really start to see a foundation. And unfortunately, that foundation will probably mimic to a vast extent the foundations we already have for other financial assets.
Well, Kevin, thank you so much for sharing your insights. It's always a pleasure to catch up, and we very much look forward to seeing you at our Manila show in June, so see you soon.